Okay. Hello, everyone. I'm going to get going at about 03 or so. Call to order. First, we'll start off with the election of. Everybody can hear me okay, still online? All right. Chair, we're going to do the election of chairperson, vice chairperson, and secretary. Are there any nominations?
John Burke for chair.
Marco Finger is vice chair. Is it? Can we make Carol do it again as secretary since she's not here?
That's what usually happens.
Yeah, okay.
Do you need a second?
Yes.
I'll second.
Okay. For each of those, okay. Okay, any, yep,
From the audience, can we just do introductions? Or
oh, sure,
just
we'll
like-
go out again, okay, yeah. Hey, Mr.
Mark Offinger.
I'm John Burt, nice to meet you.
I'm John Burbank.
Michael Freeman.
Sorry, I'm writing. Arnisha Green, HR Director. Steve Morrison, Finance Director.
Yeah, new title, she's now officially finance director.
And it's a deputy.
Stefan Shakura, actuary.
Christine is the employee benefits coordinator.
Thank you.
Thank you. Now, actually, the elect, that we have a motion for the offices, all in favor, say aye.
Aye.
Approved. Do we have any board communications? Anybody receive anything? No, I didn't either. Finance director report.
Did you want me to come up there? Can you here?
Come on up.
Or just wait right here?
Sure.
So for the quarter ending December 31st, 2022, revenues are up from last quarter. By approximately $7.5 million, which is mainly attributed to an increase in the dividend income, as well as a positive realized gain of 5.5 million. So that was nice. And then the expenditures have increased by approximately 5.6 million, and the majority of this is attributed to the monthly pension payments. So we're 6 months in with our pension payments. This quarter also reflects the administrative expenses, SEI fees, Hooker and Holcomb, Sageview, and also the fees for the auditors.
Because I'm new and ignorant,
Mhm.
I'm curious, are there cost of living adjustments that are in the?
Pension payments,
Yes,
yes.
there are. Okay. So as inflation increases, we'll see those increase as well.
Well,
We'll look at it once in a while for COLA, is it like a one-time COLA? We do it every 2 years. We look at all the retirees at once, and the council then votes on it to give it.
it wouldn't be on like a
So it's not
month-to-month
like-
basis.
No, it's
Mhm.
once every 2 years it goes up. Yeah.
If you see an increase, usually the increase month to month is based on the number of retirees there are, some passive pay.
Yeah.
Yes.
It may be, that's a great question. I mean, if you recently retire, you're not eligible. in
5
most
years for
instances
most of us.
5 years. And then it has been pretty sporadic historically.
Yeah, for many years, the
It's
council
not
didn't take it
automatic
up.
like some plans.
Yeah,
I think in the city, it's
Yeah.
automatic every year. There is.
every
some.
single year in the city. Yeah.
So it may be good at some point to kind of delve into that a little bit.
Yeah.
Just so the board, we have nothing. That's totally up to the council.
Yeah, there's a couple of bigger union contracts required to be looked at every 2 years. So you gotta be like Mark said, 5 years retired. There's one or two, there's a couple differences between them, but that's generally what it is. And then we just match that for non-union retirees also. We pretty much do the same thing. Every 2 years, we just we talk to the unions, they reach out to the retirees, kind of see what they're asking for, and then we compile and discuss and bring it to the council.
Would you know when the last time that was?
It was real recent. It was time flies though. I guess it was recent, but was that more like a year?
I feel like it was within the last year that happened.
Probably spring going into summer.
It wasn't that long ago.
Yeah, it's probably closing around middle of the year, around July-ish.
And then the only other item,
What's that?
the only other item I had for an increase in the expenditures was the, there was a couple additional return of contributions for a few employees that had left. So,
Okay.
any questions? No? All right.
Employees, the return to.
Yep. Usually it's, employees that haven't been with,
If
for
they're
very
not-
long.
If they're not vested.
Yeah.
right.
there was, maybe one of the employees had only really been here for like 6 months. So he wasn't fully vested, so. Thank you.
Um, Hopefully everyone had a chance to look at the November 10th, 2022 minutes.
So moved.
Second,
Aye.
Aye.
Authorization of payments, and traditionally, unless there's an issue, we take one motion. Paul Tedeschi and Linda.
So moved. Second.
First, second, any discussion? All in favor, say aye.
aye,
Passed unanimously. Okay, SCI quarterly investments.
Great, thank you. I'll share my screen here
Thank you.
and okay, can everyone see that okay?
Good, looks good.
Okay, great. All right, well, I hope everyone's doing well. Happy New Year to everybody. And obviously, we have a good amount of things to talk about. We had a very volatile year last year, so we'll get into some of that. I put a executive summary here on page 3, really just for the minutes, and you can read through that at your leisure, but I'll go through all these points as we go through the presentation. So it was an interesting year last year, to say the least. So if you look at just a general 60-40 portfolio, 60% just S&P 500 and 40% Barclays aggregate index, investment grade bonds, it was the worst year since 1938 for that type of portfolio. So it was a year where, you have a lot of investors that don't have pensions and they just have their 401ks and Social Security and everything else supporting them, individual accounts. People were like a couple of years away from retirement, thought they were in a safe nest egg, full and fixed income, right? And they really, really took a hit. So it was one of those years, unfortunately, for those people that are really close to retirement, they saw a lot of volatility there. And you can see that on the right-hand side of page 5. Just unbelievable. Looking at the teal lines, every single asset class was down significantly. Almost every asset class was down in correction territory, meaning 10% from peak to trough. And long duration bonds were down about 27%. So that's bear market territory for long duration bonds. So the longer duration you had, the worse your fixed income portfolio did last year. The only big winners were Treasury or inflation linked bonds, Treasury inflation protection securities. They still were negative, but they had performance in most of the market. And then obviously commodities had a really good year, and we're all seeing that everywhere we go, the grocery store, the gas pumps. So that was the big winner for the year. For the quarter, it was a good quarter, and that was reflected in the financial statements, which were just discussed. And we had a pretty strong environment. All equities are up. The big winner was international. That was the big winner for the quarter. We haven't seen that in a long time for international to lead the way for an entire quarter. And then riskier type fixed income asset classes like high yield bonds and emerging market debt also performed very well. The fortunate thing is we went into some of these asset classes a little bit more right at the right time. But again, it's a short period of time. We'll talk about that when we get into numbers, but we made our allocation change back on 9/15 of 2022, and pretty much every trade, every asset allocation decision we made worked out so far. Again, 3.5 months doesn't mean a lot, but it did pay off so far. And we'll talk about that. So the US equity markets, the trend continued from our last meeting. So if you look on the bottom left-hand chart here, you can see value was down just about 7.6% there, and growth was down just over 29%. So we saw that transition from growth to value throughout the year last year, and value ended up being the big winner. If you look at these sectors, there was also a lot of rotation in sectors, and this makes a lot of sense, right? As value is outperforming growth, you're going to see tremendous changes in sectors as well. So your energies, that goes along with the commodity story, utilities, consumer staples, those more healthcare, more defensive areas of the marketplace were the best performing for the fourth quarter. And if you look at it on a one-year basis, obviously energy was the big winner, And the big losers were those more riskier type asset classes or more growth oriented mega cap tech stocks last year. Their technology, consumer discretionaries, communication and real estate were the big losers for the 1 year period. So a lot of changes happened last year. We went through that growth story for a long period of time. So value finally outperformed the growth type stocks. Another thing to focus on in the US equity markets is corporate earnings. And I mentioned this briefly at the last meeting, corporate earnings mean a lot more now than they did. So meaning if you own the S&P 500, especially the couple of years before last year, those big mega cap tech stocks really made up about 20% of the S&P 500 index. So if you were invested in the S&P 500 index, it really didn't matter what all the other companies' earnings were. As long as those 5 companies were doing well, the S&P, and you're in S&P, you did really well. But now, if you listen to some of the earnings calls and their revenue and earnings, if they outpace the expectations, they're rewarded for that. And if their revenue forecast going forward look better or are going to improve, they're rewarded for that. And vice versa, the opposite. Stocks are getting punished when they have bad earnings calls. So that, in a sense, really means that active management is back. Stock pickers, they're back now. It's important to pick strong fundamental companies again. Again, we haven't seen that environment for a long time. International equity markets. So I know I talked about China the last couple of meetings, but I'm going to talk about them one more time here because it's very important. So at our last meeting, China still had their zero COVID policy, and that really created issues for their economy and supply chains globally. But more recently, they actually stopped their zero COVID policy or reopening their economy. They paid for that zero COVID policy last year. Their GDP growth was just about 3%. Whereas if you go back just a couple of years, they were running about 6.5%. And you can go back a couple of years before that, they were running close to 7.5. So it was a big hit to their economy and globally. Again, it impacted their supply chain significantly. It's part of that inflation story. And the market really liked that news that they were opening their economy. That's a big part of why you saw international outperform in the fourth quarter pretty significantly. A lot of that happened in December as well, November and December. The other thing is, they did reopen their economy, but obviously COVID's running rampant there now. At one point, they said 75% of their population had COVID in one form or another, meaning they just got it or they had it or they've had it for a couple of weeks. So it did impact their population pretty significantly. But we think that will wind itself down over time. Unfortunately, they won't accept the vaccines from other countries in the U.S. So it may have helped them a little bit more, but they will not accept that. The other news on Latin America, they were the big winner. They were the big winner for the 1 year period. A lot of that can be attributed to commodities doing so well, and a lot of that is commodity producing nations. So they were the big winner. But all in all, international held up really well at the U.S. for the whole year last year and outpaced it for the fourth quarter. Questions around international? Okay, so this is really where everything's happening today, right? So fixed income. So let's go back, look at the bottom left-hand chart. You can see the yield curve from 12/31/2021. We had a zero Fed funds policy. We had a nice smooth curve going upward to the right. You had more yield on the longer end of the yield curve, and you were rewarded for longer duration bonds. Well, now it's a completely different story. Rates have gone up across the board significantly because of the Fed's policy and all the rate hikes they did last year. They just had another meeting a couple weeks ago. They did a 25 basis point rate hike. So that was a little bit different. They slowed down from the previous 50. The markets like that. They hung on just a couple of words that Powell stated mainly, and they really didn't hear his hawkish tone because he did have kind of a hawkish tone still, saying that there's more work to be done at that meeting, if you listen to the call. So right now, you're making pretty significant yield on the short end of the yield curve, anywhere from 4.25 to 4.8%. And right now, the 10-year, I believe, I looked at it yesterday, I didn't look at it this morning, but it was about 3.65%. And actually the 30-year is a little bit lower than that. So there is an inversion in the yield curve, pretty significant, which we discussed in the past. We do believe there's a light at the end of the tunnel with these rate hikes. Unfortunately, or fortunately, you can say, good news was kind of bad news the other day. So the job report came out and it was actually way higher than, jobless claims were way lower than what the most analysts expected. So that's why you're seeing over the last couple of days, we're seeing a lot more volatility, kind of up one day, down the next day. We're kind of flatlining right now in the markets. But all in all, we do think, we may see rate hikes through May, but the jobless claim numbers definitely have to change and reverse course a little bit before this Fed starts to take a pause. And the good news is a lot of the big firms are reducing the chance of a recession as well. So that just happened more recently. I think Goldman came out the other day and they reduced it to like 25% chance. So there is a chance we could have a soft landing here, meaning we not hit a recession. And that would be a really good thing. And again, a very not easy to do thing for the Fed. They're in a very difficult place here to make this happen without a recession. Questions around fixed income? So we'll probably see rate hikes through May. And again, it really depends on, it's data dependent at this point in time. It really depends on the data. Okay, there's some more notes here that we discussed. And we'll get right into the numbers. So this is the portfolio as of December 31st, 2022. You're 131,177,597. And I do have an updated number, but I'll give that at the end of my presentation because I don't want to have to close my screen down here to get to that. I'll give it to you in just a minute. But a good fourth quarter. I mean, it was a nice bounce back. If you remember at one point in time, we were down over like 22%. We did have 6.72% for the 3-month number. So a really nice bounce back. The whole year, unfortunately, we're down 15.65. So we did make some adjustments to the portfolio, which I'll talk about here. But all in all, let's focus on the calendar year. And you can see the total equity return was minus 16.87%. The US was minus 18.46% of that, and the world equity ex-US, which includes international and emerging market equity, was down 14.47%. So from that perspective, internationally actually outperformed for the entire year. The US equity factor base is new. We implement that on September 15th, like I mentioned earlier. That was up 8.89%, and that outpaced the Russell 3000 and the Russell 1000 index. So again, that right now has a tilt more towards value and defensive areas. So that's why that outperformed. If we have a strong rally in the tech sector like we did in January, I'd expect that to underperform during that month. So we'll move down to fixed income. So you can see there, core fixed income has a duration of around just over 6, meaning if interest rates go up by 1%, that portfolio will be down by approximately 6% and vice versa. So rates went up a lot. It was down almost 14% on a year-to-date basis. And then we have a couple new funds here. So limited duration, we shortened duration of the portfolio to take advantage of those yields on the shorter end of the yield curve and have less volatility with rising rates. So that's new. You only see a 3-month number here. So that was up 1%. Emerging market debt was up 9% for that period. And then moving to high yield bond, which you already had an allocation to, we actually increased that by 2%. So that was up 2.28% for the 3-month. And up down 11.35 on a year-to-date basis. And real estate, as I talked about on the equity slide, that was the biggest loser. That was down almost 25%. The good news, it did outpace its index. Had a pretty strong 3-month number, so it came back a little bit, up 3.94%.
So Patrick, the asset allocation
Yes.
remains constant with these changes?
I'm sorry, no, well, The asset allocation, once we set the asset allocation in the policy, we maintain that asset allocation until we make a change to it,
Okay,
which we did in September of last year. We made a change to the asset allocation, but it was more so along the edges, right? So we didn't really change how much was in equity versus fixed income. We changed what was in equity and what was in fixed income.
okay. And are there significant costs to switching between different funds and, bringing new things in?
No, there's not actually. So these are all daily liquidity, all these funds, and there's no cost really associated with it all. These aren't separate accounts. These are daily struck NAV mutual funds, 40 Act mutual funds.
Thank you.
And then we just have calendar here, the next couple of pages. So you can look through that at your leisure. So just a general summary. We've been talking about asset allocation changes for about 1.5 years or so. We made the change in September. So we moved a little bit more into international because we had a significant overweight to US, which in itself over long periods of time could create more volatility. So we moved a little bit more into international, take advantage of those valuations. And we also moved more defensive in some of the equities. So we went a little bit more defensive posture with US equity factor based. And we also added a little bit more to high yield, 3% to emerging market debt. And then we also added the limited duration fund. So we added a pretty good amount to limited duration to shorten the overall duration. So limited duration is around 12% of the portfolio now.
Maybe it's a dumb question. We're seeing these changes in international and short duration, things like that. And then we're switching money into those things. How do we know if we're moving money into those things after they've peaked out and they're not that's not going to continue in the future, like sort of fighting last year's battle, so to speak?
Right. Well, right now, I mean, for limited duration, you're right. I mean, if we go into recession, core fixed income could outpace limited duration, right? Because rates could drop back down, the Fed could cut rates, and that will make core fixed income be your best performer, which is why we kept a pretty sizable position in there at 25%. But I mean, overall, we believe these are better long-term changes for the portfolio and the strategy, because limited duration right now is yielding just as much as core fixed income, but you don't have to take on that duration risk, right? You don't have to take on that the volatility of interest rates going up for a significant period of time longer, or even vice versa. You're still going to have that nice yield to clip, and you won't see as much volatility, especially a pretty well-funded plan.
Okay.
U.S. equity factor base actually doesn't just sit defensive. So that strategy can move into more growth areas of the marketplace, for instance. So right now, the factors are still pointing towards more value, but there is, we have momentum factors in there, we have growth factors. So that strategy doesn't sit still. And none of these strategies do, none of the active ones do. We have managers, multiple managers that we hired at SEI implemented in all the active funds here, which are mainly fixed income and US equity factor based. But they're constantly making changes to take advantage of what's going on in the marketplace. They were doing that all last year.
Okay.
Now, what was the total of the sub-asset class changes back in September? I mean, I know we kept the stock to bond ratio the same, but basically just made some smaller tweaks.
What was the total percentage, or? I'm sorry, I need to hear. Could you repeat that?
You're on mute, Mark.
Sorry about that. I've been having some technical difficulties. Pat, I was just a question around the changes you made last year. It was kind of around the edges to take advantage of kind of the shift to international and the outlook for short-term rates versus long-term rates. But overall, it wasn't a huge change. What was the overall sub-asset class changes that you made?
That's on the executive summary page. So we have it right here. So we did move, all in all, we did move 3% from equity into fixed income. So that was a change there. The main reason for that was we did add emerging market debt, which we can turn a return enhancement asset class, right, over time. So that's why we took that from the equity side. But all in all, really wasn't a big move. We had 39% fixed income. That was spread out into 12% limited, 3% emerging market debt, and we added another 2 to high yield. And then on the top line, we took 5% out of the US large cap equities, put that in factor base.
Yeah.
And then we took some more out of US and put that in international. And we did that in conjunction with your firm. We had several calls over the last year or so about that.
Yep. Great.
Any other questions?
I'm just curious on your swing here in real estate property. It was up 45% in 2021. Now it's down 25%. That's a huge swing. And how actively is that being looked at? Because the rest of the numbers are fairly stable for the past 5 years. But I was on the state IAC for 9 years, and we took a beating in real estate and took most of our money out of it in the 2000s. So I realize it's a different market, but that's a huge swing from plus 45 to minus 25.
Yeah, that's right. So, I mean, again, this is a very small portion of the portfolio that was mainly done from a diversification standpoint, just to have access to that asset class. That's also a
what we said too, but it was $400 million we lost.
Yeah, well, this is
It may be small, but it's still $4 million that there was more there last year.
Right. I don't have the since inception numbers here, but if you still look over a 7-year period, that asset class was up about 5.6% over that 7-year period. So it's still adding value over a longer period of time. Obviously, we had with everything that happened, COVID and what happened with the real estate last year was it's not, this isn't like core property fund. It's not like an alternative asset class. It's liquid, it's REITs, things like that. So it is very volatile. It is very volatile, but.
Okay, thank you. That makes more sense than what I was thinking you were doing.
Yeah, so I mean, but also, I mean, with core property, it's interesting because with core property, I mean, a lot of people were overweight to core property because for instance, our core property fund was up almost 24% last year. And then what happened was everyone got so overweight to it, they tried to pull down their allocations because they're overweight by 6-7% to their target. But now they're gated from doing that. So they have to, we have to do it proportionally over time. And that's happening across the industry right now. We're seeing people trying to get out of it because they're overweight, but they have to.
I get it. You've answered my question. I understand. So it doesn't look as bad as I thought it was.
Okay.
Thanks, Pat. Anything else?
Thank you.
Okay, moving on to Sage View. Pat, you can put sharing screen.
Yeah, I can share my screen. Again, apologies, Mark Forkey speaking. I had some problems joining earlier and seem to have solved those. Hopefully you can see my screen. I think Pat did a good job of laying the basis of what we're seeing. This chart just a little bit different visual of the last 50 years and kind of breaking different returns sequences by year. So up top right is a year in which stocks and bonds were both up. We've seen many of those. Conversely, last year, one of the 4 of the last 50 years where stocks and bonds were both negative and really compounded by fixed income's negative return double digits. So, really bad environment, as Pat talked about. Stronger fourth quarter and year to date after a pretty good start and just double checking real estate performing pretty well. Just a couple of quick hits on, these never happened before, back-to-back negative years in equities and fixed income And generally fixed income has rallied after negative years pretty strongly, double digits. Our committee, I think, sees things pretty similar as Patrick's. Looking at the asset allocation and where we see other clients, pretty consistent with that. We're kind of happy with some of the strategic decisions, just to change the underlying sub-asset class holdings, and nothing there kind of jumps out. So won't go through all this. I think our view is pretty consistent. We think we're getting a little bit more clarity on what the Fed's going to do. We're kind of down to 1 or 2 increases in rates in March and May. Unfortunately, the good news of a strong jobs report, is seen as a negative to the Fed, which may make them push rates up a little bit higher and potentially leave them there a little bit longer as well. This is our economic scoreboard. So this is our 18-person investment committee's kind of thesis for the year, trying to take a look at what's positive, neutral, and negative. The neutral sometimes are the most worrisome, in that they cause uncertainty in the marketplace, and that leads to higher volatility. But we are anchored by a strong job market, which is leading to higher wages and keeping consumer spending afloat. We'll kind of monitor that as we go potentially into a recession, and if we do, hopefully it's a shallow one. All eyes on the Fed and inflation to see how that works out. We're hopeful that the Fed will pause and let the data catch up with the rate hikes, and then hopefully at some point, maybe in 2024, we could actually see a rate decrease. I think some folks in the market are maybe expecting one earlier. We just don't see that happening, but encouraged with the inflationary news. Negative still kind of manufacturing, housing, corporate earnings, as Pat said, all eyes on corporate earnings, especially at the company level instead of the index level, but not as strong as a year ago. And we didn't get as much help from the federal government as in terms of Build Back Better, which was shot down at the end of 2021, and the smaller fiscal spending announced in the summer of last year. So I think pretty consistent. Won't go through all of our charts, but there, if you want to take a look at it, similar content in a different format.
We did, and I think you guys have all heard Secure 2.0, which has been passed. This legislation had over 100 impacts to the retirement plan industry, changes to the retirement plan industry. Of those 100 plus changes, there's only about 10 that actually impact defined benefit plans, and they're very minor changes. A lot of the changes were extending a provision that's currently in existence today out further. So no real large impacts for defined benefit plans, pension plans. However, there is quite a bit in the way of impacts to your 457 plan. So I know that this is not the forum for that. If at any time anyone has any questions with regard to Secure 2.0 and wants to talk about your defined contribution plan, happy to get on a call or come down to see you all and walk through that. These impacts to your defined contribution plan are going to be burdensome from an administrative standpoint. So again, just wanted to make an update as to Secure 2.0, where that's going. Again, no impacts on the defined benefit plan, but there are going to be plenty in the on the defined contribution side.
Great, thanks, Mark. Any questions on 2.0 at this time, or if not, I'll summarize just kind of our monitoring of the underlying investment funds. Great. Okay, so as most of you have seen, SageView has a proprietary scoring process for actively managed funds. It looks at 9 criteria, which we think are important for long-term retirement investing. And as you'd expect, we look at performance, the consistency of that performance, the risk-adjusted metrics. Is the fund taking too much risk or not enough risk? Are they getting the return that they're looking at? How they hold up in an up market versus a down market, and from an expense ratio level, how do they rank? On this chart, it might be a little bit hard to see, but I'm on page 22 of our deck. It basically has a report card of how each fund scored versus their particular peer group or competition. The funds that continue to score well You mentioned it quickly, I think at the last meeting, the newer emerging market debt. This is a very small asset class, and there's not a lot of peers. And the numbers are going to swing pretty heavily because of the smaller subset of the group. We were comfortable with the fund. It's performed well since we put it in. It does score kind of in the middle of the road or slightly into the third quartile. But the performance since it's been added to the Town of Groton plan has been strong. Other funds, especially the fixed income funds, top quartile, US equity factor, kind of a little bit of a different type of fund, but it performed well, as Pat said, added some value to our return in the fourth quarter. And the real estate fund also scores out very well, top quartile for us. Index funds, a little easier to track. We're really just looking at the expense and the tracking error and any additional deviation from a risk return, managing of cash. All those funds pass our scoring. So no major concerns. We continue to see the portfolio underlying investments are strong. We're comfortable with the position of the portfolio, and we're hopeful for better the year than last year, that's for sure. So those were my prepared comments. Any questions there?
In that fund performance summary, top quartile, top decile, what is pass?
Yeah, good question. So for actively managed funds, we're going to put them in, we're going to give them a numerical score, which we took a look at. For index funds, we use more of a pass-fail. So generally, if the funds are in the top two quartiles, we'll label them as pass.
Got it.
So yeah, a little bit different. We look at the index funds a little bit different. So these quartile scores will match up with the numerical scores in the prior chart.
And are you grading on a very, very aggressive curve? How many fail?
Only the emerging market debt fund fails. So that's the only one that.
Oh, no, I mean, in general, I mean.
In general. Well, it's a ranking system. So in roughly 50% of funds will fall in the third or fourth quartile.
Pass fail. On the pass fail, what percent?
Same, yeah. So we're for index funds. Yeah, it would be a 50-50 as well. Usually with an index fund, it's going to fail because their fees are high, or because for some reason they may not track. They don't have a good tracking error to the benchmark that they're trying to replicate. Usually because of fees, higher fees.
Thank you.
Okay.
Any other questions? Thank you, Mark. Yeah. Review of actuarial valuation. It hasn't been loaded now.
Hopefully, well, I did send it out, so everybody hopefully has it. Well, just wanted to pull up for people remote, but if they don't have it, be sure all the Sage View people and the SCI people got it.
Yeah, on the website.
Yeah, well, Lori said that you'd be able to pull it up, or I came in person.
No. Yeah.
She didn't tell you. She didn't give you that information. I wouldn't expect her to put it out there. But. She would have sent it out Friday.
Yeah, that doesn't make it though into, unless we're told we don't preload it.
Oh, okay.
And it normally is attached.
Oh, she couldn't attach the.
She couldn't add that part of the presentation there.
Because there was a separate email she had sent out with the final report and evaluation.
Yeah. You'd have to pull it from your email attachment, I guess.
Yeah. You don't have access to the email.
The difficulty. No. Oh,
I
sorry
can,
about
if
that.
you, I can share it as long as you say the page numbers. I have it
Yeah.
up on my screen.
Yeah, pull up the presentation, not the valuation report. So what the document
Okay,
came on Friday.
hold on 1 second here. Let me get that. Is it labeled October, December 2022 quarterly pension?
No, review of the July 1st, 22 actual evaluation. Or,
Okay, I have to go
remember.
back another email. Hold on a second.
yeah, it would have come on Friday afternoon, I think,
Friday.
from Lori. Yeah, there's two documents attached in that email.
Yeah, so I see the
Yep,
the valuation report.
That's
which-
it. Oh,
Okay.
that's it. All right, so just jump onto the purpose, the first page, or I guess page 2. Just for, I don't know how many new people are out there, but just remember the purpose of the valuation report is because the town has promised to pay some benefits for their active employees in the form of a pension plan. So really the cost becomes what you have to pay for those benefits. So that cost, you have benefits that you're going to pay, and then the expenses would be actuarial, auditing, accounting, legal fees, process and benefit payments. And then you want to offset that cost for the town by employee contributions. So most of you, I think all the unions put in some portion of contributions. And then the biggest variable is that investment return in that box, right? The better that the assets perform, the less money that the town has to pony up. So that's why it's very crucial that, you invest properly and you manage the funds. That's what these guys are doing. So remember the valuation is a tool, right? That to help you manage that total cost that you're going to expect to pay, right? So we come up with a contribution or a budget number that the finance group will use to allocate for funds for that 1 year. So we do that each year. And that's really just a tool. It doesn't tell you what the ultimate cost is, right? Because that varies from year to year based on a whole bunch of variables, one being the investment return, benefits, or how the salaries go. But so this is just to manage that cost each year to give you a fixed number that you can budget towards that to pay off that ultimate goal of paying all the benefits when they come due.
I'm sorry,
So
Mark, could you please stop sharing your presentation? I can't pull mine up. There we go.
Okay. And
How does it work from the town? We get the report from them and we automatically take the number that they give. Is there a statute that requires us to fund according to the actuarial? Or actuarial?
Well, here we're just accepting the report.
I see. So there's discretion that's available to the town council or?
Right.
yeah, they have discretion whether they're going to fully fund it or not.
I think there's an ordinance that requires.
Yeah, a lot of towns do have some kind of stipulation where they have to fund whatever that contribution is.
I'm not sure, Joe, you want to get into that discussion.
Well, I think they did, a lot of them adopted that because towns and states were not funding adequately.
Yeah.
And that's why you hear of all these plans that are unfunded and financial stress. Yeah.
So, and our role in that is to accept the recommendation.
We accept and file it at these meetings, right? We don't have any control over it.
We can't go in and jigger the numbers. Evaluation is the valuation.
And a lot of times the boards get separated from the town, so the town doesn't kind of push numbers down, so to speak. Right, so that when you set the assumptions and make sure we're using proper assumptions as opposed to saying using a rate of 8%, which would lower the cost kind of things like that. So I think that's why you get the boards involved in recommending or certifying numbers that the town will ultimately budget.
So our function in this chain is to receive and sort of validate.
Bless, I guess, yeah.
Yeah, but I mean. Evaluation is being done in part based on actions that the retirement board has made in terms of the rate of return and so forth and so on. That the sample of the census of people that are in the program
Basically,
We
we're getting
can't,
the results.
that is what it is, right? I mean, it's kind of, so based on what gets presented, we may then have a further discussion in a month or two. Should we do something with the rate of return? And there's been a lot of change in the rate of return over the last 10.
Yeah, and we'll touch on that at the end, but not to jump ahead.
I have a 4:30 hard stop. So
Okay,
I want to make sure we keep it.
what's the time? Yeah, okay. I can go as fast or as slow as you guys want, so usually it's a matter of how many questions you ask. So as I said, so we develop a contribution, which we call the actuarial determined employer contribution, and that's kind of dictated by GASB, which is the government financial board. And that has two components, one being the normal cost, and that the normal cost is what active employees earn, the benefits earned that year. And the bigger piece that tends to be is the amortization of the unfunded liability. That is past liability, for whatever reason, funding that didn't get made in the past, right? Because if you always funded 100% fully, you'd be fully funded typically. So that piece, that's the other piece. And what we've done with that piece is we do layered amortization now after a couple of years ago. Instituted that. So back in 20, we said whatever that number was on unfunded liability, we're going to amortize that over 20 years. And each year, the change in the unfunded liability that slice will be amortized additional 20 years. So that big piece will be after 20 years will be done, and it's just going to be the little slices from each year after. That helps you kind of manage that to make sure there's no intergenerational inequity, right? Your people that are earning the benefits are the ones that are paying for it during their working lifetime when you're funding. Next page. Quick overview of what things that has happened, before we get into all the numbers. You guys talked about a COLA. There was a COLA as a cost of living adjustment. So there was a one-time adjustment of where it was 2.5% for certain groups on the town side. And I say the town side because there's in the pension plan, there's a town as well as the Board of Ed, except for certified employees, no teachers and administrator in a different group. But it's on the town side, those retirees got a 2.5% adjustment to their benefit if they retired before 7/1/20. So that would be that 2-year span. So it was effective 7/1/22 that went in play. We didn't make any other assumption changes this year. I know I've been spewing every year that there's always going to be at least one change, and that being the mortality improvement scale. What's happened with that is that the side of actuaries that produces the tables, the information they were getting, they get information every year from the Social Security Administration as well as CDC and a couple other. What's been happening the past year due to COVID is data has been unreliable or spotty, so they're still kind of going through that. And as I say, that is, think of it being differences between gender, your geographical location, your ages, so it's different areas, so the South may have higher rates of mortality than the North kind of thing. So there's a lot of things like that are going into that they need to make sure they vet in before they just throw out a table. So just wanted to point that out. There were a couple of plan changes that happened this year. One for vesting, I think, for the police union or non-union group, as well as another one did change their averaging period from 5 years down to 3 years. That had a minor impact. COLA impact, 1.7 million increase in liabilities. The plan change is a smaller increase of only 300,000 liabilities. So there wasn't really big numbers, but the COLA did have an impact. On top of that, there was additional losses of 3.2 million, or just about 3.3 million on the liability side, and another 750 almost on the asset side. The asset side shouldn't come as that big of a surprise, although that ended up being a much smaller number than I would have anticipated, but it wasn't that bad, and that's due to part of the fact that we do smoothing on that. Assets on the actual value of assets earn 6.5 on the market value -13. Just so you make sure you understand the difference. An actual value of assets is a smooth asset that we use for funding purposes, and that is that we use to go against the measure against the liability on this purchase for your funding budgeting number. A market value of assets is used in the financial reporting of the plan. And that's the financial part of your financial footnotes that the finance director will put together. That'll go in there, and that's on a market basis. So if you looked at the 6/30 GASB report that just went out, your funding level would be much lower than it is in this report. Last bullet is, you have 11.33 million in unrecognized. That's a typo. It should be losses, not gains. Gains was last year when we had that great year last year. So we have that. What that means is that the actual assets that we're using for funding is 11 million higher than the true market value. And so as those come closer, as those those losses get recognized, assets are going to come down a little bit, and that means your contribution is going to go up. over the next 4 years as that smoothing takes effect. Here I put, an average 270 a year, but that's not really what it's going to be. It's not going to be 270 each year level. So the first 2 years, that increase will be smaller, maybe 180 to 200 for those first two, because the bigger changes of the losses happened in the last 2 years. So those slices will be bigger. Again, that's if there's no other gains or losses in the next 3 or 4 years. Okay. Next page.
First of all, I want to understand the mechanics of it. So there's a 20-year thing, and so little tranches of increases or decreases based on that.
Correct.
Each year that gets adjusted. Right?
Each year there's we measure the liabilities and the change in your funding level, whether it's it lowers it or increases it, like it's increased the last couple of years, and that you'll have another charge, so to speak. In other years, when it goes down, it'll be a credit. Again, that the year it occurs will be amortized over 20 years. Similarly, your mortgage on your house. Okay. This page is about the actual experience. So we talk about the unfunded because that's really the shortfall. As you can see, last year is 30.7 million. You have a normal cost that increases that liability, right? Those are benefits earned again, offset by contributions by both the employer, by the town, as well as the employees, adjusted for interest. We expect it to be about 30 million. Before any changes were recognized, it came in at 34. So that gives you 44 million loss. And I told you it was 3.3 on liabilities and 700, a little over 740 on assets. And remember, the losses or gains happen because differences of actual versus expected, and those tend to be salary increases. If there are higher payrolls in the past year, that'll generate losses. Decrements, when people retire, if they terminate early or late, and as well as whether they die or not. So, and all those things, we do a fraction, but in reality, we know it's not, not a part of you doesn't retire, right? You either retire or you don't retire. So when they retire, it tends to, depending on where they are on the scale, it tends to generate a loss. And the other piece would be whether the benefit was bigger or smaller than expected. Okay. Then the next two lines show the assumption that COLA. I call it assumption method, but really that's the impact of the COLA, that 1.7 million. And the plan changes to 326. So now your unfunded is $36 million.
So it went from about 30 to 36.
Yep.
A 20% increase.
Yeah, I don't know if that's, but yeah.
It is, I was, when I looked at that, I said, is that starting with them or that like 20% in 1 year seems like
it is big, right? So you think if you just think about one of them, the last two, that the COLA change, right? We knew that's going to happen, right? Because they looked at COLAs from 2% to 4%, and they settled at 2.5%. So they kind of knew that was something to do, and actually you probably picked the right time to do it because you're going to probably get favorable results from the they may say it wasn't big enough, but it's probably well received in 22 when it occurred. So not everybody does COLAs. So yeah, it is. It shouldn't be too surprising due to the fact that assets more or less tanked the past year.
Yeah.
Last year when we were at the meeting here, everybody was all smiles and happy because they got 25% or so returns, right? See how things change in a year. Now you're down to almost -13%. And because the number was bigger, the asset value was bigger, you have more losses now, on a scale.
absolutely.
Yes, on a dollar scale, right? The gains last year, even though it was 25%, were 22.
Whammy of COLA plus reductions in the market.
As well as, like I said, liability experience. Sometimes liability you get gains, if everything goes the wrong way, you get a bigger contribution, kind of, so to speak. Okay.
Many women, this is not obviously a bad number, but it's not over a long period of time. These are things that one experiences.
Yeah, and
just pray to the great God of offsets. That could be another year.
absolutely. When you give a big pay raise, you hope you get that on the backside somewhere else. Maybe people leave early. So, for instance, say the reason why the vesting doesn't cost as much, right? Because it went from 10-year to 5-year, and we assume people go out a little bit, right? So if you're going out after only 5 years, you haven't had time to earn a bigger benefit or get the salary increases with that go with it, as well as promotional increases that typically go to the side. As if they went for 20 years, their benefit would be much bigger than if they went out at 5. Okay. Next page, won't go too much detail, but it's just the cash flow of the assets. Market value, you know. Big number at the beginning, 153. Lost all the way down to 129, right? So you got your cash flow, you have 6.3 in contributions. But you know, think about that benefit payments, 10.6. So right there, that shows you a negative cash flow. So that difference usually gets made up by the investment return. And the year it loses, it kind of gets a double impact that you're kind of talking about, right? Now you have that you're short 4 million already out the door, out of the pocket, plus the additional asset, you know, loss of return that you got. The other column, again, is what we fund on the actual value. Went from 136 to 140. So you had a slight return on that one. Again, that's the impact of smoothing. All right. Next page is really just development of the actual value of assets. Because most people don't understand that concept. The top block shows the 129 market value, the 11 million of unrecognized losses, right? And that gives it, because we haven't recognized them, it just inflates your market value by 100 to 140 million. The middle section kind of shows what we expected the assets to be. From 153, we expected to be just under 160. It was 130. So you get that 30 million loss. Again, like I said, that magnitude is much bigger. You see that in the bottom block, right? You see that 30 million in column A, that's a loss. Whereas last year it was almost 23 million, right? And even though the return was much bigger, again, that was on a smaller number and scale. That's scale. As I said, we recognize 1.9, which is column C each year. That's kind of that 20%, that 1/5 of each piece a year. So again, we'll see that 18,000 will drop off again. That's why you don't have as big of a change. So the impact of that recognizing the loss will be only 180,000, as opposed to when you get the bigger pieces like that 6 million, that'll be a much bigger change in your contribution. But ideally, by then we'll have offsetting gains to minimize that impact. All right, next page. This is just kind of a snapshot of the liabilities. Again, we compare last year to this year. Liabilities. So you really, you know, in total, they went from 105 to 114 on inactives, you know, so now liability is 167 to 177 this year. We expect it to grow a little bit each year, right? If an open group, right, as we get new entrants. As well, we expect the liability to grow up by interest, less any benefit payments that come out. Again, plus you had more new entrants. So the overall population we'll see at the end is, you know, probably 20, 30 bodies more. Assets didn't improve as well. So in a funding level, you really only drop from down 2%. So that's not horrible. I've seen others that have dropped, you know, closer to 8 to 10%. So in that regard, it's not as bad as you may think. You know, the 6% or the 20% that you said the increase in unfunded is. In the grand scheme of things, it didn't hurt your funding level as bad as it has in other towns. The other block there is just, again, what I talked about, that amortization of that unfunded liability. You can see the swath of each layer there, and how we do it. So again, if it goes down, you'll have a credit 1 year. So keep moving on. I don't want to keep to your schedule there. Next page is a graphical representation of how the assets have performed. Actuarial being in red, market values being in bluish purple. And really, they've kind of followed along each year, except for the last 2 years. Really, you know, they've been pretty close in that 5 to 10 range, which we don't usually see. Usually see a lot bigger swing in the market value from the actuarial. So they've been kind of hitting pretty close to the target, at least. Not going over too high over or too down too low, except for the last 2 years. So that kind of crossed the board for everybody. Next page 9 is just a graphical representation. So I'd like to see the picture of the actual value assets to liability. The purple, again, being the liability, red being assets. You know, you want to see that gap between the two bars to be a lot closer. Just means you're better funded. And it looks like you've been pretty consistent around that 80%. I'm looking at just by eyeballing it probably in the last, 7, 8 years. So you're consistent. You're on the right path. You're doing your job of maintaining the plan, not letting it fall behind. You're staying ahead. Next page 10 is again another graph, kind of, people like pictures, the funded ratio, assets to liabilities. Per,
Like that, when the delta to 80 to even that 20-year thing designed to close that gap.
Yep.
And so we expect to see then not a stable ratio, right? That 20% should actually be,
ideally, again, that's if you didn't have any gains or losses, right?
you know,
So if you had no gains or losses, then yes, every year it would be a step closer. So that means, so for instance, last year, that step got bigger because we lowered the discount rate from 7.25 down to 7%, which is the long-term investment rate of return. So that drove it up a little bit. You know, so things like that, those changes. Mortality's been tweaking it down a little bit. When it first implemented it, it was a big increase, but then the improvement scale kind of stepped it down a little bit each year.
when would you know that you're in trouble?
When you're in trouble, you mean what funded, you know, everybody has their different.
80%, if it never, ever, the gap never closes, are you, I mean, could you sustain at 80% forever as long as you're at 80%? Because
Well, if you're making good on fully funded, the recommended contribution, because it's designed to make you sufficient, really is be sufficient to pay the benefits as they come due, right? Remember, again, this is just a mechanism to fund, right? It's not truly, it's kind of a snapshot of where you are today in one way of measuring the liabilities, right? So by continuing to progress the way that you're doing it, making the contribution, you know, paying a chunk of that unfunded, as well as the piece of that benefits earned each year, you are actively sustaining the plan. Ideally, you're hoping your investment, ideally, like I said in the beginning, you want those investment returns to be a lot bigger to help offset that. That's really how you close that gap, so to speak. Because like I said, you're gonna have another little sliver each year. If it's, hopefully it's a credit, then it's
the difference the town has to contribute more is that if that never even. If we were at 95% right now, the town would have to contribute as much.
correct. Because you're,
This year, where are you seeing other towns at in terms of percent funded?
like I said, you've only dropped 2. I've seen them drop.
But overall, what, at 80%, how does that kind of rank compared to others?
We can, you're probably higher than a lot. I mean, 80% is a good bar to be at. I mean, there's plenty I have that are 50%, you know, it's, you know, I was talking to one, he's like, do we want to go under 60%? Because it was dropping down, you know, and we're talking about lowering the investment rate of return. You know, but again, there's a lot of things that you think about in that, you know, okay, sometimes want to be at 80% or 85, like they kind of want that to be their level. And so they've done that in the past to make sure. So now they want to maintain that, and you should be able to maintain that. Again, what you get that little fluctuation due to assets, right? Because if you earn, if there's no gain or loss in assets, you'll definitely stay there because you're doing what you're supposed to be doing. And you probably, you know, then you only have liability gains or losses. But yeah, I really have to look at them. I've seen them, like I said, I've seen them drop more.
Generally, we're always over 1200.
Yeah, 80% is good. I mean, there are definitely, I have ones that are 85, 90, 95. Most of them not as many, you know. Most of them are in the 60 to 70 range. But again, I'd have to survey them all. There's a chart in the back, but again, it's a little outdated because it's from the CAFRs from the prior year. You know, when we do the ones in another couple of months, you'll see where everybody was at 6/30, 20 or 22.
When that information is available, you get it to John so he could get it to, you know, when the.
Yeah, we typically send it to D. If he's on our mailing list, we would send it to him directly as well.
You'll send it, otherwise I'll get it out to everyone.
Yeah.
I mean, from my time, you know, doing bond attorneys, so we were always above, pretty much well above it.
So it affects credit rating.
Oh, yeah. Yeah, it's all. So,
Yes, and
Yeah, all these things are interconnected.
yeah, well, there's more scrutiny nowadays on how your pension plan is, and so in the past, you know, when we talk about plans using a long-term rate of return of 7.5, 7.75, whatever. So those credit agents started looking at that. They said, okay, you're just playing with the numbers.
Yeah.
It's not a true representation of how well funded you are. You know, so now they look, if you're using assumptions that are hard to defend, you know, a 7.5 to 8% rate of return, they're going to ding you on that because they're going to understand that they may have some kind of load where they adjust the liability again on that. They'll look at how you've been paying your ADEC. right? So if you're fully funding the ADEC as recommended, that's a plus, right? If you overfund it, I've got to believe that's even a better thing. Then they'll look at the other assumption, they never used to care about other assumptions. So mortality has been a big one in the last few years. When the new mortality tables came out, that pub tables, because that basically said everybody in the public sector was a lot longer than everybody in the private sector. And it drove everybody's numbers up, so it was a hard pill to swallow back in 1920 when towns started adopting those tables. But keep moving on, page 11. So it's just the development of that ADEC, right? And you can kind of see, the top block shows the normal costs and the contributions, right? It went from, the town's normal cost was $2,070,000. Now it's 2,224. Part of that is new entrants, a couple little tweaks that happened there. Again, we expect the normal cost to grow. If you have the same population, you expect it to grow by pay raises at a minimum, right? So that's not unheard of. If the plan was closed to new entrants, eventually it would reach a pinnacle and it would start going down on a closed plan. But an open plan, it would be expected to go up a little bit each year.
And we won't get into it now, but the town with two union groups, one's very small, have to agree to a cash balance plan, which is a defined contribution, but that acts kind of like a defined benefit because you're guaranteeing a certain amount of return. However, it's fairly new in the municipal world. It has been way harder to get settled than we ever thought. It's been about 3 years now we've been working on it. We didn't do a defined contribution though, because it closes off the new money coming in. You don't really see a savings for, some people think it's a savings, but it takes at least 10 years before you see a savings.
And remember, there's different things that you look at when you do those plans, whether it's a strict 401k type or whatever, that 401a is retention, right? What's attractive to participants, right? And from what I've been hearing, and I haven't heard it from here, but it's very difficult to replace people that have left. Retired. Everybody's short staffed. So you don't know how many people I've talked to that have trouble getting this information because they're doing 2 jobs, 3 jobs.
I hear that from every town.
So it's across the board. So that's why you start to enhance benefits or make things attractive.
What's hurt us is there's sometimes going to 4-day work weeks. People love that.
No, I haven't heard that. No one's told me that.
People, there's a couple around here that do that. We've lost candidates to that.
So, okay, moving on, that next big piece in that middle second block, unfunded liability, right? It went from 2.8 to just under 3.4 this year, right? And that's well, you said 20% increase in unfunded liability. So that's kind of where you'll see that. So it gives you this year contribution last year was 5.1. This year it's just under 5.9. So that has gone up. The next page, I try to, because I figure I get asked the question, show kind of some of the components that drive the increase in the contribution. Again, so this shows not the ones I showed at the end, but more before you adjust for timing, right? So you typically adjust for the year to the budget year, which is typically a year out. So you add the year's interest or increases in there. But you can see rate of return, the asset loss drop, increase your contribution a little over 65,000. Liability losses almost 290,000. The COLA about 150,000, a little bit more than we expected. I think we were budgeted around 130. So I think there was 1 or 2 or something I've fine-tuned to see who affected it a little differently. But so we kind of knew that 150 was happening. Plan provisions 52,000. I think that wasn't so much on the police plan, but more the shortening the averaging period from 5 to 3 years. That tends to increase it, right? Because now for a shorter period means you tend to focus on the higher salaries. So that's not surprised that did it. The new entrants. So there's quite a few new entrants and they don't have a liability, but they do have a normal cost that you're going to put in this year. So that's about another 200,000. Also, the decrease tends to be people that left, other kind of liability, minor things that kind of the catch all. Those are kind of the key components that kind of drove the change in contribution from one year to the next. The next two, 13 and 14, that's more the detail by group. That's not really for this group, but more internal and how the town allocates costs. So we need to spend any time on that. Page 15, the contribution trends. And the key thing I like to point out here is that purple on the bottom is the normal cost. Again, that's the active employees, the benefits they're earning. that red or orange, or however it looks on screen, that's a little big. I like to see that a lot smaller. Because that means that's liability or benefits you haven't paid for in the past. And that's on that portion of the unfunded liability you're paying now. So I like to see the purple to be, 3/4 or more of that piece, right? Because then it's easier to swallow. It says, hey, we're paying for the people that are working for us today, not for people that worked for us yesterday. So I don't really want to see, we know it's going up, last year or so went up because of the change assumptions. I bet 22 was probably my different mortality table implementation. I don't think we did them at the same time, if I recall. And again, like I said, it'll go up each year just as the population earns more benefits. Page 16 is just kind of a reconciliation of the data, that you see. We went from 360 to 363 actives, but again, the lump sum payments are very short-term people that just probably got to return their contributions, people that weren't vested. A lot of retirements, those tend to draw generate some losses, right? Depending on where they are in their scale and how close their benefit was to what we expected to be. But you had 51 new entrants, so that's where that 200,000 is coming from, all those people. You get some gains due to mortality when people die. But again, if you expect 10 people to die and only 5 people die, you're going to get some losses. If you expect 10 and 15 die, then you get gains. That's not the morbid part of it, but it is a part of the conversation. Page 17 is a key place. If you're going to open the report and want all the information kind of one place, and it's probably page 2 or 3 in our actual report. The executive summary shows last year compared to this year, all the changes. So one of the things I said is the population, you had 719 last year, so 742 this year. So you would expect there's some call, wherever those people fell, you have, what's that, 23 more people now. So there's more 23 that are driving the cost up a little bit. Salary went up. I don't know. I don't have my calculator to know what that is. That might be more than 3%, 4%. It went up 1.5 million, looks like. Average 70 to 74,000. I don't know. That'd be more a question for Christine or something. How pay went. Did you guys put out and give more pay raises than in the past? Some things could be like during COVID, things might have been frozen, and then you have retro pays that can catch up. I don't know if that occurred or not, but so those are little things that kind of happen. The rest of the pieces we all kind of talked about, the liability assets. So that kind of has everything. Your point earlier, the next on page 18 is that report we produce. What we analyze all the CAFRs, kind of see how you compare. You can kind of look at where you are. So it says 21 versus 20, but you got to think about that's really 20 versus 21, right? Because it's June 30th, 21 that they're looking at. So it's a lag in a year. So like when we do this year's, it'll be for June 30th, 20, right? So your drop from 7.25 to 7 won't be on this one, but it'll be on the next one. So think about things like that, but you can kind of see the trend has been going down. I bet you this year, everybody's going to stay probably the same just because contributions are going up. Most don't have the appetite to really take that hit if they're trying to. And plus all the groups, all the investment advisors, the capital market assumptions they're coming out with, they're showing like 7.5, 7.75, but again, that's a short-term thing. So I put air on caution to increase their rate after all these years of working to get them down to where, can you remember, it's not a 10 or 20 year horizon where this plan is expected 50, 80 years kind of thing, right? So you got to think about where we expect, do we expect rates to be at 8% for 50 years? So just kind of shows you, and then to your point, the next page shows you the funded ratio. So you can kind of see where they are. 21 be the blue. So this is going to be a little rosier, right? Because this was going to capture the assets at 6/30/21. That's the gain. You're going to see a shift to the left when we do the report this year, I would expect, right? So you're still going to be in that. You just dropped under that 80%, right? You were 79.6. So unfortunately, you'll be where that 29% bar is in 20. So everybody moved up. You can kind of see where all the purple started going up. And now next year it'll be the purple will go in the red will be, purple will go down. So looking ahead, things to think about. 7% return, is that where we think long-term? We had been talking, maybe 7, I don't know what the ultimate goal, I don't remember if the goal was 6 3/4 or not, but now with higher rates, I'm thinking there's probably a pause on that. No one's gonna do anything. I think we're gonna see what happens next year, another year or two. But, so it's just to think about, in the last bullet, I said that a drop of 25 basis points, about 550,000, just a little over $500,000 increase in your budget. They say the unexpected loss, expect that 1.9 million. I said, I showed that earlier. That's that 20% sliver due to the operation of the smoothing. Would I expect the contribution to go up next year at 7%, 180,000? Again, that's that one piece that drops off as that assets, with no gains or losses, the assets step down, right? Because we start to recognize those losses. Remember, it's overstated right now. Again, internally, the Board of Ed is 88% funds versus 78 on the town side. So hopefully I kept you on your timeline, gave you a lot of information. I don't know any other questions. I have the report if you want to ask there anything in the report.
Would it be possible to get a copy of the slide deck?
Everybody should have it. It should have been emailed on Friday.
Friday.
Didn't show at the time, I guess, for the mailing. It's in the email.
So there was an email.
Yeah, it's a Friday.
Okay, no, that's okay. I'll check.
Yeah, there was 2 attachments, my presentation, and then you said her financial report maybe was in there.
You said it.
Yeah, Laura said they were Friday, yeah, early.
Middle, 1 o'clock or so. No, that's fine, but you just reach out. Easiest way is to get them through one of those guys right back there, or Nisha, or that's who has all the, actually, obviously Lori does have all the reports, so.
It
If anybody doesn't have it, it's lovely.
it was sent out by Lori.
Lori, yeah.
Okay.
Yep.
We do need a motion to accept the file.
So moved.
Second. All fair say aye.
Aye.
Fascinating stuff. Thank you.
I think we had talked about, we put this on our, about scheduling an investment policy workshop. Is there an interest in doing that sometime soon? Receive that. Need.
Well, isn't this something we generally do once a year? Something.
Yeah.
I just don't remember.
Is that inclusive of all my sort of fundamental questions I started asking? Like,
Yeah,
how to play
yeah.
role versus- It's more than just investment. I think it makes sense.
What do we look like for schedules to?
In the past, sometimes we actually have a special meeting.
Yeah, it'll be-
Sometimes
yeah,
we've
yeah,
actually
yeah.
just added it to a regular meeting. Maybe
How long does it
started-
usually take in the past for those?
All depends on,
Yeah,
to some degree, what,
yeah,
this is where we basically go through, and I mean, when Tim was with us.
Yeah.
He was a taskman, that we had to do this every year, we looked at the investment policy, and it was a workshop, so it went over an hour or two.
usually meetings don't go real long, and maybe we mentioned just a little bit, if people meet just a little bit earlier in our next meeting in May. Would that be possible? May, yeah. Okay. Did you do that?
Yeah.
Maybe 2 o'clock instead of 3, would that work? Does that work, you guys to do a, investment policy workshop, do it at 2 o'clock next time?
Yeah, that would
Yes.
work for us.
Okay, great, thank you. We'll plan that then 2 o'clock. And other than that, just any other business? If not, I'll entertain a motion to adjourn.
Second.
Okay, all fair side? Good, thank you. Thanks, everyone.
Thank you, everybody. Bye-bye.